Hey everyone, and welcome. In today's explainer, we're going to tackle one of the most powerful, yet so often overlooked tools in the world of precious metals. We are going to decode the gold to silver ratio and figure out how it can signal some major opportunities in the market. All right, let's get right into it.
For any investor in this space, this is the million-dollar question, right? Do you go for the bedrock stability of gold, or do you aim for the explosive potential of silver? It can feel like a total guessing game just trying to time the market based on the daily price swings.
But what if I told you there's a better way? A method that lets you see past all that day-to-day noise and instead focuses on the deep, historical relationship between these two monetary metals. The real secret, the key, isn't about their individual price tags. It's about their value relative to each other.
And that brings us to our key metric, the gold to silver ratio. It's a really simple calculation, but trust me, it is packed with information. So if the ratio is, say, 80-1, it just means you need 80 ounces of silver to buy 1 single ounce of gold. This number is going to be our guide for this whole analysis.
It's funny. This ratio hasn't always been this wild. For most of history, governments just fixed it, like the US did way back in 1792 at 15-1. But ever since the 1970s, the free market took over, and that's when we started seeing these massive swings from one extreme to the other. And that's where we come in. For investors, those giant swings, well, that's where the opportunity is hiding.
So, what's the deal? Why these huge swings? Well, it all comes down to the fundamentally different jobs that gold and silver do in the global economy. Because, and this is crucial, they're fundamentally different beasts.
Okay, picture this. Fear grips the market. We're talking recessions, financial crises, you name it. What do investors do? They run for safety. And the ultimate safe haven has always been gold. This flood of money into gold, while silver kind of gets left behind, stretches the ratio, pushing it higher and higher. But then, what happens when the fear fades and the economy starts humming again? The whole story flips on its head. See, silver isn't just money. It's a vital industrial metal. It's absolutely essential for modern tech. So as industries ramp up, their hunger for silver can make its price just take off, way faster than gold. And that pulls the ratio right back down.
And wow, this chart just says it all, doesn't it? Take a look at this breakdown. More than half of all silver demand comes from industry. We're talking about everything from solar panels and electric vehicles to all the electronics in your pocket. This industrial backbone gives silver a totally different engine driving its price compared to gold.
Okay, so this brings us to the absolute core of the strategy. Because this ratio swings between these two poles, fear pushing it up, growth pulling it down, it creates this powerful pattern called mean reversion. The best way to think about it is like a rubber band. You can stretch it, but sooner or later it's got to snap back. And catching that snapback, that can be the difference between a decent return and a truly incredible one. And if you look back, history just screams this pattern at us over and over again. In the 91 recession, the ratio hit 100. The 2008 financial crisis, it jumped to 90. The 2020 market panic, it hit a crazy all-time high of 125. And if we see a future crisis where it spikes over 100 again, well, it's just history repeating itself. Every single one of these peaks is that rubber band getting stretched to its absolute limit. This quote from GoldSilver.com just hits the nail on the head. These extreme levels, they're not normal. They're signals that the relationship between gold and silver has gotten way out of whack and is probably going to correct. The big takeaway here is that these peaks aren't some new normal. They're a blinking sign that a reversal is coming.
Okay, so let's play this out. Let's see what this snapback actually looks like for your wallet. Imagine the ratio peaks out above 100. In the recovery that follows, maybe gold has an awesome year, right? An impressive 67% gain. But silver? Oh man, its performance could be just explosive, maybe surging 147%, more than doubling gold's return. This shows you the raw power of using the ratio to spot when silver is on a historical discount.
Okay, so that's the what and the why. Now let's get to the how. How do you actually use this information to make smarter decisions? Let's get practical.
It really just comes down to 3 pretty simple steps. First, just watch the ratio. Think of it as a vital sign for the precious metals market. Second, learn to spot the extremes. History has shown us time and again that when that ratio gets above 80, you're in a zone where silver is exceptionally cheap compared to gold. And third, use that signal to shape your strategy, to think about shifting your allocation a bit more towards silver when that opportunity pops up.
Now, let's be super clear about something. This is not a crystal ball. okay? The ratio is not going to tell you the exact day or the perfect price to buy. What it does, with incredible consistency, is signal when a major value opportunity has opened up. It helps you buy when something is on sale, when it's just fundamentally mispriced, not just when its price is already moving.
All right, so let's shift gears and look at what's coming down the pike for silver. Because if you look beyond just the ratio, the fundamental story for silver looks stronger than ever. It really does look like a potential perfect storm is brewing.
I mean, just look at these tailwinds. Let's run through them. You've got record-breaking industrial demand, thanks to the green energy revolution. The market is expected to be in a supply deficit for the 6th year in a row. The physical supply is getting tight in key areas like the COMEX exchange. And maybe the biggest game changer of all, some central banks are now actually buying silver for their reserves, treating it like money again.
So, when you put it all together, these powerful fundamentals plus the historical playbook from the gold-silver ratio, it really leads to a fascinating question. With its dual personality as both timeless money and a metal that's absolutely essential for our future, is silver positioning itself to be one of the defining assets of this entire decade? It's a question that, honestly, every serious investor should be asking themselves right now.